Candlestick pattern, the hammer, with its long lower shadow and a close near or at the high, is easily understood to be a bullish signal. The term hammer derives from the fact that the market is hammering out a base, or that a bottom is so solid that it does not break, even when a hammer knocks away at it. An aspect of the hammer is that it must appear after a significant downturn or in an oversold market to have significance. The hammer is a reversal indicator, and as such, should have a downtrend to reverse. A hammer that appears after a fall of say, 2 or 3 days is usually not important. Since the hammer is most useful after a significant downturn, it should be noted that there may be selling on a rally from the hammer. As such, the first bounce from the hammer may fall and the market may return to test the hammer's support. Consequently, trading with the appearance of a hammer depends on a trader's aggressiveness and risk adversity. Some traders may decide to buy immediately after the hammer appears in case the market does not pull back to retest the hammer. Some traders may decide to wait to see if the market returns to the hammer, and if so, will buy on that return move. If the market successfully tests the hammer's support area, there is then a more solid support area and a better chance for a rally. A method which is recommended is to lightly test the waters from the long side after a hammer, and then add the remainder of the long position after and if there is a successful test of the hammer. Whichever methodology is used, a stop based on the close could be placed under the lows of the hammer. A useful trading tool with candles is a Western technique called a spring. A spring occurs when the bears are unable to hold prices under a broken support area. Because such action proves that the bears were unable to grab control of the market when they had their chance, it should be viewed as a bullish development. The opposite of a spring is an upthrust. An upthrust occurs when the market makes a new high, but then fails to hold that high. We will discuss more about upthrusts when we discuss shooting star in upcoming videos. An ancient Oriental book on military tactics referred to gaining an advantage over the enemy by acting as a moving shadow. This term, as used by the warrior who wrote that book, means that when you cannot see the state of your opponent, you pretend to make a powerful attack to uncover the intention of the enemy, to gaining an advantage over the enemy by acting as a moving shadow. This term, as used by the warrior who wrote that book, means that when you cannot see the state of your opponent, you pretend to make a powerful attack to uncover the intention of the enemy. This concept, as related to trading, is one of the reasons a spring is so important. Probes of support or resistance areas are attempted throughout the markets by large-scale traders. They want to discover how the market will react once a support or resistance area is pierced. In effect, these traders act like the aforementioned moving shadow, will now learn about the underlying strength of the market. If the market fails to hold under a broken support area and forms a spring, these moving shadows, that is the sellers who were attempting to probe the market, now have learned about the tenacity of the bulls and as a result may decide to cover their shorts.